James Shugg is senior economist with Westpac Banking Corp, and he's here with us now. So, QE3,
Maryam, obviously lovely to be here. Yes. QE3, why? Look, on our forecasts, the US economy is going to be growing at a 0.9% pace, Q4 last year to Q4 this year. The Fed's current central projection is 2.7 to 2.9 on that basis. Now, of course, those numbers were from June, so they don't incorporate the significant downward revisions to GDP that we've had since then. And ours does incorporate that, but we also incorporate ongoing headwinds that keep slowing, down the economy, and it's not just temporary factors. And I think
which is what Bernanke was arguing.
What it was, but he's now starting to recognise that there may be some more permanent factors holding it back, and that's one of the things we think he will certainly discuss today. To what extent is this slowdown temporary? What factors would worry him if they were clearly starting to emerge? I mean, 0.9% growth through the year, unemployment closer to 10% is a consequence of that, and of course inflation will be falling in that environment, core inflation as well. So we think that the case will gradually be made, but it's certainly clearly not made yet for a lot of people on the Fed, and I think it would be very unwise for him to actually signal a commitment to do QE3 today.
So James, if there are more permanent factors holding the economy back at this point, after both QE1 and QE2, well, what reason do we have to believe that QE3 would then make any difference to these deeper structural issues?
That's a good question, because we're not necessarily convinced it's actually going to do too much. It'll probably benefit stock markets, and they argue that that in itself helps people feel more confident and so on, but he certainly doesn't want to be seen to be targeting the stock market. But what else can they do? There's the fiscal policy, there's no room there. They can't cut interest rates any further. You need to really look outside the box if you want, possible policies to put into place. Why not give green cards to Greeks and Portuguese and Italian families who've got a bit of cash, as long as they
thinking outside the box.
As long as they buy a foreclosed get Chinese people to come over. Lots of dosh, but they buy a foreclosed house. That helps lift house prices in the US. And it's free. It doesn't cost anything to do that. And then these people bring with them spending power. If Obama could start coming up with innovative policies like that, then you could potentially have a bit more of a successful response rate.
All right, so some creative solutions from James Shugg there, but we have to question the benefits of more QE, don't we, when long-term borrowing costs are already so low? And
part of the reason they're so low is that people think there's going to be more QE and that the bond yields will fall as a result of that. So one of the risks we confront today is not only the stock markets pull back quite sharply if Bernanke doesn't signal it today, but we'll see bond yields push higher. I mean, that's going to be a bit of a short-term...
Would that boost the case for QE further down the line?
Possibly it would, yeah, because it would show that the way you get bond yields down, get mortgage costs down, is by the Fed embarking on this asset purchase program. It doesn't have to be the same form as the last one. It doesn't have to announce a big number up front. You could do it incrementally, like the Bank of England did. Announce, say, 50 billion a month or whatever. He could target bond yields, not say how much they're going to spend, just say we'll spend what it takes to get yields to this level. Or they could announce, look, we've got a really big number in mind, but we're not going to tell you what it is.
They just keep on coming, don't they, James?
There's all sorts of different ways you could do
What
it.
about this idea of QE with a twist? So they wait till the short-term securities mature and then invest in long-term bonds, and that would eliminate the inflationary risk?
That's right, because it's kind of sterilising it. Yes, that's right. So in effect, it's not really QE, but it's a possibility that he might also want to countenance. There's a whole range of things he can talk about that he would do if their current view, which is the economy will still recover, proves to be wrong. That view will prove to be wrong over the rest of this year, and about October, November, you'll see Fed officials seriously starting to suggest that probably in the early part of 2012 we are going to do it.
How much do you think it's going to be? Because a lot of guys
50
like
a month.
50 a month. Yeah. A lot of guys like you are saying, well, part of the reason QE1 and 2 didn't work is because it didn't go far enough.
Yeah.
I mean, how much further do you have to go?
Well, that's the thing, and I fully accept the trade-off between growth and inflation. Becomes less favourable the more you do. What we're arguing is that inflation will be lower than they think because of the much weaker growth scenarios that we're painting. And the other thing that would be great is get the Bank of England to do it at the same time, the Bank of Japan to do it at the same time,
coordinated,
and get the ECB to do it at the same time.
So I'm just wondering, we were speaking before about these deeper structural problems in the US. You said growth is still low, unemployment still very high. But then when we speak about the possibility of more QE, it doesn't seem like anyone thinks this is going to help those two issues. It's just a case of, well, what else can we do? It's like we're aiming for the lowest common denominator.
It's an element of that, but I think the view is that QE2 did do something favourable. It lifted equity markets, which boosted confidence.
But that's not what the Fed are there to do,
James.
I mean,
they are there to improve economic activity,
okay.
and that's the means by which it has been working. I mean, but the other issue, though, of course, is that this is a very different recovery to a normal recovery. Housing is not participating. New home sales are down 25% on where they were when the recession ended 2 years ago. Housing is going backwards still. Now, that's critical because without that happening, the various data sources that the statisticians use to calculate GDP and jobs, their births, deaths models of businesses and so on, are all wrong. That's why you had the huge downward revisions to growth published at the end of July. That's why in July next year, you're going to see current year growth numbers rise. We're on the cusp. The US is on the cusp of recession right now. It's just that it won't be clear in the data until a year's time. This is serious stuff, okay? The payrolls numbers next month are going to include a benchmark revision.
But then what, I mean, if the Federal Reserve, I mean, looking at rates, QE2, we would assume 10, 30-year rates haven't really moved. We went up, we went down, we're back to where we were. Is this not now more Obama has got to step in with some shrewd policy? You talked about thinking out of the box before the break. Obama's really got to step up to the plate in terms of being shrewd about how he uses his money. It's not all just down to Bernanke. We can't all just wait for Bernanke to save the US.
Absolutely, but what I'm saying is it is a seriously critical problem because it is so much worse than the current numbers are telling us about.
Right.
Because the benchmark revisions will reveal probably 500,000 jobs that were created up to March this year weren't in fact there. They're imaginary. So the January, February, March numbers looked really strong. They probably weren't. So the labour market is in worse shape than we think. The economy is probably on the edge of recession right now, but we just don't know it yet. They should be thinking about these issues, though, in formulating policy.
I'm just wondering, picking up on that point about what policy Barack Obama can actually implement, what measures the government can take. I suppose the debt ceiling negotiations showed how impotent potentially the administration is. So actually, is it all on Ben Bernanke's shoulders?
Well, no, monetary policy can't do everything. All monetary policy can do is put in place the conditions in financial markets that encourage economic activity.
Right. But it's not happening.
But it is happening, and it was happening to a slight extent, probably less than we currently are told. But you're right, there is other arms of policy that need to be explored. And as I said, there are ways you can do it that don't cost anything.
But what can Obama do? What can Obama do? What can he add into this equation?
Just
tax breaks, labour breaks?
It impacts a lot on the fiscal issue, to the extent that you don't actually see your budget position improve. It probably wouldn't be helpful for bond yields. So there is a dilemma. You've got to come up with these ideas that don't cost you anything. Bring people in from the rest of the world. Get them to buy foreclosed houses. There will probably be the law of unintended consequences at some future point, like race riots in 10 years' time. You have people coming in from all over the world.
We've already had unintended consequences from QE. This liquidity pouring out to emerging markets.
You get that with every policy you put in place, I think. These are uncharted times. The fact that the housing market is still in recession and people aren't therefore consuming anywhere near like they normally would in a recovery means this is a totally different ballgame to what we've seen in the past in US recoveries.
What about devaluing the dollar? I mean, is that?
It is devaluing.
Well, I know it's coming lower, but I mean, everyone wants
to devalue. Even Australia now wants a weaker Aussie dollar because the domestic economy is in difficulties. So I think that one part of the things that really help, of course, would be the Chinese letting their currency appreciate, but that one day down the track maybe.
All right. Well, thanks very much. Great to talk to you, James Shugg of Westpac.